Welcome to Investors Insight, where today's topic is second half and earnings. A lot going on. With tariffs, new updates on tariffs last week and over the weekend. Before I talk about what we're expecting and what history says about the second half performance of the S&P 500, Trey, talk about earnings, the importance of earnings, especially tied into with the new tax bill.
Yeah, thanks, Bobby. Earnings are always important. Economist Larry Kudlow says that earnings are the mother's milk of the stock market. Earnings drive growth. So it's always important. But this earnings season takes particular importance because of how much has changed since last earnings seasons. Rarely does a corporate tax code change so drastically from one quarter to another, but that's what's happened. So the massive changes in CapEx deductions and R&D deductions, it'll be very interesting to see how corporate America projects that forward, because it won't impact today's earnings. It'll impact the future earnings, but they're going to want investors to start investing based on those capital expenditures that they'll start to pull forward and use. That will be positive. So these will be an expense on the front end that will go against their taxes, which is positive, but it should set up for growth going forward. So what we're looking at closely is how is corporate America going to use the new tax bill to their advantage and to investors' advantage. Secondly, we really want to see how corporate America is using AI. Has that started to improve? That's a capital intensive investment as well. And then the tariffs at the end of the day, who is absorbing that tariff cost? We got some interesting news out of the budget department for June. The U.S. government brought in $100 billion more than last June, so that's a positive. But almost all of that came from individuals and higher individual income taxes, higher payroll taxes, and then a third of that came from tariffs. None of that came from higher corporate taxes. Actually, year over year, corporate tax revenue is down 0.4%. Now, it's not that revenue data isn't detailed, so we don't know which corporations are taking on that extra cost. But it's clearly hitting corporate bottom lines. And so how will corporate America explain that? Is that taken on by public companies? The S&P 500, again, is the 500 largest publicly traded companies. That's what we watch closely. That's what impacts our investors. The majority of corporate America, however, is private and much smaller. So where is that revenue hit coming from? Because it's flowing through to taxes. So a lot of data is going to be coming out of these earnings announcements, not just the end of the day, how much do they make, what are they projecting, and how are these CEOs, the best CEOs in the world, how are they adjusting to the new reality, good and bad, very important. And it starts with a bang with the large financial institutions we'll be reporting this week. And they really have their fingers in every part of corporate America. All the banking runs through these institutions. And so where the money flows, that detail will be very important. So we'll get a lot of data right off the bat, but then we're going to be following it throughout all of earnings season.
Yeah, so earnings and then also corporate guidance are really important to what Trey said about driving stocks. And so after a fairly volatile first half of the market, our attention now turns to the second half to see what the market has in store for investors. So as you can see in this first chart here, we have some historical guidance with how the second half might go. And the chart here shows second half returns for the S&P 500 following a range of first half return scenarios. And so the S&P 500 had a volatile but solid first half. And so after an impressive recovery from a deep correction in April, the broader market actually wrapped up the first half with a gain of 5.5%. And the big question now is whether this momentum can continue in the second half. So since 1950, the S&P 500 has followed up with a positive first half with an average second half gain of 6.1%. Furthermore, when the first half gains were within the range of 5 to 10%, as you can see in the chart here, the index also posted average gains of 6.1% in the second half, with 86% of occurrences producing positive results. So, as always, no guarantees, but we like what historical guidance says about how the market will perform in the second half of the year. So, we're following earnings very carefully here. We like what historical guidance shows in the market for the second half of the year after a positive first half. So a lot to cover. If you have any questions on anything we've discussed, call us, email us. We love to hear from you. Have a great week. Thanks.